this guy working? It is. Great to be here. Great. Well, I guess one of the things that when I was asked to do this, I immediately wanted to bring Mike on because I think he's one of the best thinkers in this space that I've talked to. And I think one of the things that's really interesting is the growth of short volatility. And I know Mike and I both think of shortfall as, in many ways, an alternative form of fixed income. And one of the ways that we can evaluate the tremendous growth and interest in short volatility is by seeing it as an institutional alternative for fixed income. So what this chart is showing is the yellow line, the kind of yellow bar line, represents the kind of average pension nominal return assumption. So this is what the average U.S. state pension needs to get on its investments, about 7 to 8%. We see various lines here. These represent the yield you get on investment-grade corporates, and then the yield you get on a U.S. Treasury, a 10-year U.S. Treasury. And then we have the yield you get by selling a collateralized short vol position on the S&P 500. So the 10% out of the money put index, or 10% out of the money put, what type of yield are you receiving if you sell that collateralized? And if we look at it, this competes with traditional fixed income instruments. Now back in the 90s, you're the state pension system, you don't have to do anything to put your portfolio in investment-grade corporates in order to meet your return assumptions. But increasingly what we saw is post-financial crisis, as interest rates dropped and dropped and dropped, short volatility became a competitor to fixed income. And this has led to an explosion in the short vol trade. Upwards $10 billion of overriding strategies, now upwards of $40 billion. We've seen another $8 billion in mutual funds emerge that are short-selling volatility systematically, and a $2 to $3 billion short ETP kind of from the retail end of things. A tremendous explosion in short volatility as a yield alternative in an ultra-low interest rate environment. This has had really unique effects on volatility itself. A lot of people talk about how vol is so low, how vol keeps going low. Well, the story is not so much that vol is low, but the story is the behavior of the underlying volatility. It used to be that when vol dropped, volatility tended to cluster, where low volatility led to lower volatility, or high volatility led to higher volatility. What we've seen is a highly unusual structure in vol where vol mean reverts at a level that's the most extreme in history. So what this is showing is the propensity for volatility to mean revert over a 1-month period. And it's using realized volatility, not the VIX index. It's using realized vol dating back to the 20s. And what we can clearly see is the 3-year period ending in 2015 represented the lowest level of vol clustering in history. What this means is that any high volatility was immediately lower 1 month later, and any low volatility was immediately high 1 month later. This is this buy the dip, or more accurately, short the vol spike. And increasingly what we've seen, I think Ben talked about this in the first panel, was this idea of that a vol spike is not risk. It represents an alpha opportunity, or at least that's the way people are perceiving it in this environment. It's created this environment where everyone is trampling over each other to short volatility. And the net effect of this, so you have a dynamic where 50% of the EPS growth is being driven by institutionalized share buybacks. That is a vol suppressant. Then you have institutions coming on board to short volatility every time it spikes up. That becomes in itself a self-fulfilling suppressant. Then you have $200 billion worth of vol-targeting funds and other risk parity type of products that are using volatility as a proxy in their measurement of risk, which is further exacerbating this dynamic, this race to push vol down and to push markets up. This is like a snake eating itself. This is a phenomenon called Ouroboros. What happens is when a snake becomes overheated, it gets confused. And it looks at its own tail, and it looks at its own tail as a source of food. And it begins to self-cannibalize. This is what's happening to the stock market today. And this is what institutionalized share buybacks, leveraged share buybacks are doing, short volatility strategies are doing, and what all these vol targeting strategies are doing. And it looks fine in the short run. From the perspective of the snake, this snake has just found a mouse. It looks happy. It's fat. But if it keeps self-cannibalizing, we know what will happen to the snake. It will die. And this is that critical juncture that we're nearly coming into now.
As Chris mentioned, he and I have had a dialogue for a long time. So I actually met Chris when I was running portfolios for a firm called Canyon Partners. And we had a credit-focused fund. We had a mandate to make sure that we were buying insurance. And I looked at the world post-2008 and said, hey, wait a second, people are way overpaying for this. I want to be selling this, but I have to have somebody who can help us think about that. I tried to hire Chris. He was smart not to take it and instead to pursue his passion. But the world that we've entered into today is an entirely different one. As Chris highlights, we're increasingly focused on the idea of selling volatility as a source of return and independent. I would actually go back and steal one of Chris's slides very quickly here and point out that this volatility clustering effect is exactly the opposite of what we just saw in the presentation. Right? We now know that we're actually seeing a regime in which the VIX is increasingly less dependent on how it was in previous periods. Right? So we're seeing the exact opposite of what most of the academic studies and most of the quantitative systems are actually built on. You see a snake again here. Okay. I want to highlight that there is a critical difference between risk and outcomes. And to illustrate that, I just want to show a video of a viral video that went out the past couple of weeks. If you've seen, I apologize. If you haven't, it's a pretty interesting one. Maybe we can play the video.
Attention in the water. Attention in the water. This is the Orange County Sheriff's Department. Be advised, State Parks is asking us to make an announcement to let you know you have paddle boarding next to approximately 15 great white sharks. They're advising that you exit the water in a calm manner. The sharks are as close as the surf line. Thank you for your cooperation.
And the point is, no one actually died. Everybody was fine. And so people will ask you as you start talking about these sort of scenarios, well, what does risk actually mean? Right? Does it mean that it's all going to collapse and that we're going to see this end badly on an immediate basis? Of course not. Right? This is a stochastic process. But what is actually happening is we are underwriting volatility risks at levels that are way below the fundamentals. And that's just exactly like paddleboarding with 15 great white sharks. One of the things that I would highlight is a lot of people focus correctly on the idea that we are actively selling vol, whether it's through products like TVIX or VXX or through systematic strategies that are designed to harvest volatility out of the futures. One of the areas that's underappreciated, that we actually think is one of the largest sources of vol selling, is systematic smart beta products. Right? And this is true for almost any systematic strategy, that whether you are explicitly short vol or implicitly short vol is actually irrelevant to the functioning of the markets. I would actually highlight just the fact that you think that you can engage in systematic strategies, which means I think the world going forward is going to be represented by the data that I've plugged into my model in the past. It's an inherently short vol strategy. Right? But if you think about what a smart beta or a factor quant is doing, you have a payoff function. This is not a daily return measure. This is a payoff function. So the x-axis, for lack of a better benchmark, I'm using the S&P 500. Your payoff of the portfolio is on the y-axis. The 45-degree line, by definition, is the S&P 500. It's 1 for 1. And all smart beta products are going to show you a beta less than 1, with the idea being we are generating some positive alpha that's a function of how we weight our portfolio versus how the benchmark is weighted. Okay, and what we know about this product is that if the S&P goes to 0, anything composed of the S&P has to go to 0. The components go to 0, it goes to 0. And so what we actually know is that this structure changes at some point out of the money. Right? There is by definition, the SPX has to be equal to a call minus a put plus the PV of divs plus the PV of K. And what you see with this orange line is that you've, at some point K, you've sold a fractional call, you've sold a fractional put. This is just a short vol strategy by another name, right? The returns, the alpha that we generate from these strategies are just short vol strategies. It's just the sale of a fractional call and a fractional put. And this is pressuring the realized and the implied levels of volatility that we're seeing. As Chris mentions, there's a million other sources that are going out there. Corporate share buybacks, explicitly put selling strategies. Right? There are quantitative strategies on the long-short framework that actually work exactly the same way, or just levered variants of this. Right? The other thing that happens is this is what this looks like under your historical modeling. But as money flows into these strategies, instead of having an uncorrelated strike price, what you suddenly discover is that the factors become increasingly correlated and collapse effectively just to the market beta. And so when you hear people talking about correlation and factors and multi-factor models, which is what we're actually seeing in the market, all that's happening is we're now selling at the money straddles. And this actually sets up a payoff function. Sorry, I'm going to go back. It didn't come up properly. It sets up a payoff function where unlevered strategies can actually lose more than 100% of their underlying exposure. So this is one of the situations we're in. Now, what this means is that you're short a straddle. And what I want to highlight is how human beings manage short straddles. I apologize for the quality of the video, but it's awfully hard to find. So this is a young woman who is managing a sliding cart in 2 dimensions. She can go up or down, and it has an inverted pendulum on it. She's trying to balance it, right? And this is symptomatic of somebody who's running a shortfall position using delta hedging to manage it. We'll get it up. Could I have the video, please? Sorry. Okay. We all know this. We've all been short straddles. We've all delta hedged them. It's boring. It's hard. You make small incremental mistakes. Right? But that's what the market feels like to us, and we're familiar with that. This is what happens when you give the job to machines. Now, that was a single inverted pendulum. What I'm going to show you here is a triple inverted pendulum. No human being could do this. This is actually introductory programming and control theory. And increasingly what you're seeing coming out of the automation of things like robotics, but is also directly applicable to what we're talking about here. If I go to this video. Now, does that feel like the S&P today? Now, the crazy thing is this is actually what's happening. Right? So we have multiple factors, multiple markets that are exposed to what we would have called back in the crisis basis risk. Right? Trading the VIX against the S&P, or credit vol, credit spreads, or rate vol, FX, they're proxies, and they behave in similar fashions under normal market conditions, but we've unleashed algorithms that are engaged in the process of cross-asset arbitrage that is driving it to impossibly small movements. In robotics, there's a characterization of the transition point between human beings and robotics. And there's something called the uncanny valley, which is where a robot resembles a human being close enough that is actually incredibly repulsive to you. Because you know there's something deeply off. We've been through this in our personal lives. We've all seen the situation. It's just off. This is what's happening in the markets. They look like markets. They feel a little bit like markets. But there's something inherently off. It's not the market that we're used to. And this is something we really need to be quite thoughtful of, to say the least. All right. So with that, today we sat down at breakfast. I mean, perfect illustration of this. The second largest economy in the world was downgraded last night. Nothing happened.
Nothing.
I mean, when the U.S. was downgraded in the summer of 2012, I believe it was, we had a 12% correction. I mean, you know, this is a caution sign. This is warning. You should be aware that this is what's happening. Recently, the Financial Times profiled the XIV, the inverse VXX ETF, called it the money tree. The idea being it was up 700% last year. Everybody should just be long XIV. There's 9.5 million shares outstanding in the XIV. There's 16.5 million shares short, something that was up 700% last year. No wonder hedge funds are underperforming, right? But the reality is that the reason why people are short that instrument is because they're actually shorting it against the VXX. Right? They're gamma scalping. They're basically making an observation that if I'm short a product that is up 10% and I'm short another product that's down 10%, and I do this over a continuous period, that volatility drag, the difference between arithmetic and geometric returns, becomes pure profit for me.
It's incredible because talking about this, I mean, we were mentioning it this morning, that you look at VXX, and oftentimes in the media people quote the amount of short interest in VXX, and no one's looking at the level of short interest in XIV. Yeah. So the two combined are essentially being put on as a short convexity type of trade. So in that framework, this concept of vol as risk, which is, right now everyone is evaluated by Sharpe ratios. And so institutionalized finance has this idea that volatility is a measurement of risk. But we all know in practice that's absurd. Vol is not risk. But despite that fact, we might laugh about that. That's how everyone in this room is being evaluated. Now, vol reached an all-time growth. Vol reached below 10. The VIX reached below 10 in February 2007. That was a period of time where very low volatility, but very high risk. Risk itself is the probabilistic expectation of a drawdown that can will ruin somebody. So in this framework, it's interesting that we all would nod our heads and agree that volatility is a horrible proxy for risk, yet all of institutionalized and quantitative finance is built on that premise. And low volatility is the primary driver that enables many of these strategies to, in essence, put on more leverage to
Amperance in return,
yeah.
This is actually the core of the problem. If I were to ask people to raise their hands if you believe in the efficient market hypothesis, right? 1975, 1980, my guess is a significant chunk of the room would raise their hand and say this is absolutely fantastic. Now most people would totally dismiss it. And yet the premise on which we're actually making all of these decisions, in which the algorithms that are balancing these markets, they're perfectly premised on the idea that efficient market hypothesis is true. It's embedded in modern portfolio theory. Right? And we know that there's things happening in modern portfolio theory that can't happen in modern portfolio theory. Right? We're experiencing, we heard it earlier today, I believe Ben Bauer was talking about it, the idea that rates offer hedging, 10-year rates offer hedging against performance of equities. Well, this is a phenomenon that emerged post-1998. It's a response function from the Federal Reserve where they step in and reduce interest rates, or the expectation is that they're going to reduce interest rates in the face of a market shock event. Right? Prior to 1998, the relationship was reversed. Higher bond prices were actually positively correlated with the S&P. Right? Why? Because we were actually worried that the Fed was going to take the punch bowl away in the form of inflation targeting. They were more worried about inflation than they were about financial market robustness. And this kind of, to me, brings up the final point, which is why does this matter? Right? Are we, it's great to tell you you're paddleboarding with 15 great white sharks, but does it actually mean anything? Right? Is the VIX an indicator, or any of these things indicators that we should be paying attention to? And the problem is, again, what was kind of articulated in the earlier model. If we know the level of the VIX, we know the level of the S&P in today's world. Right? And what we also know is that that's not a model that's really working anymore. It's one that's being forced into solutions, right? And it's being programmed into machines so that they're trading on this extraordinary amounts of basis risk that are being assumed as we do this, right? But we when you're faced with that type of environment, the real challenge is, and this is the other thing that I spend a lot of time talking about demographics. If you actually look at what's happened in the markets this year, you've seen extraordinary outflows from U.S. equities from the retail sector. Why is this happening? Because the baby boomers are retiring. They need to move their assets out of financial markets, out of high volatility assets, into consumption vehicles. That's what it's there for. That's what retirement assets are there for. It's required by law that they have to start selling these now. And you're seeing this. It's actually in the data. And on the other side of that, what's actually driving up markets, what's influencing markets, is that we're seeing the institutional space, the professional investor space, and the short vol space has just exploded. Exposures have really dramatically risen.
You know, it seems like there's always this thing about if you're either long or short vol, it seems like two different sides of the equation. I always sit back and say it's not short vol I have a problem with. It's systematically shorting vol that I have a problem with. Consistently and systematically, under all conditions. There's this implicit idea that you can always roll that trade. So if we go out, we're in a casino right now, if we go outside and go to the blackjack table and I start doubling down every single time I lose, the dealer, maybe has a high school degree, will laugh at me. So this is a terrible strategy. You're just going to lose all your money because he knows I don't have an unlimited bankroll. Nobody does. Well, you'll hear that from the dealer, but at some point, someone who's trying to defend systematic shorting volatility will come online and say, I love it when volatility leaps up because it gives me a new ability just to sell it at a higher level. Well, that might be so for relatively normal moves in vol. But if you end up having a large enough shock in volatility, there's numerous problems with this viewpoint. There's no difference. If you think about it, there's no technical difference between saying I'm going to go ahead and short volatility at a higher and higher level, rolling up my bankroll, than it is to necessarily say I'm going to double down at the casino. There's no real difference conceptually. Anytime you are running a martingale process or essentially increasing your bankroll into an exponential process, you run the risk of ruin unless you have an unlimited capacity. Even if you assume that isn't true, even if you're a massive pension system, you say, you know what, it's no problem, we can handle it. You're also making assumptions that you have continuous access to markets, that your ability to roll the position will not be impacted by liquidity or margin disruptions, or for that matter, you're also making the assumption that there's not going to be any internal or external pressure for you to dial down your positions, or that losses in other illiquid parts of your portfolio won't impact your ability to roll the position. And you're also making the assumption that markets will immediately revert back. Now we'd expect that nowadays, but look at Japan. People who would have actually, people are still waiting for a return from 1989. So there's numerous problems with this assumption. There is a smart time to short volatility. That the period after the Great Financial Crisis, up until about 2012, was an excellent risk-adjusted period of shorting volatility. I think both of us would agree on that. I wrote a paper about it. Mike actually made a lot of money executing it. So he did very well executing that and was right on about it. But there's a time and place. But if you try to systematically do anything ad nauseum without value in mind, you'll set yourself up to failure, particularly if you're positioning yourself against a nonlinear process. And any blackjack dealer outside will tell you that.
Yeah, I think that's right. And I think ultimately you're looking at a situation here where the leverage is embedded in a couple of different ways. One, I continue to go back to the slide that Chris put up, which is expectations of return, or more accurately, requirements of return in order to fund consumption on a look-forward basis. That's what financial assets are for. That's why you save. You save in order to fund future consumption. That margin of safety, we already know, is extraordinarily low. We talk about underfunded pension plans. We talk about debt crises in terms of the inability to actually meet these obligations, whether it's at a public pension level or it's at a private pension level with undersaved boomers. Right? One of the things that has mystified academics looking at the past several years is why haven't we seen more of a wealth effect? And And why haven't we seen more of a consumption reaction to the increase in asset prices? My question would be, why do you think we haven't? And we have a population that is getting increasingly old. I can tell you my consumption patterns as a mid-40s man are far different than my consumption patterns were when I was younger. I certainly know that those who retire, they actually consume at levels that are below those who are unemployed. And that's all the growth of the population going forward. It's all retirees from here on out. In the developed world, you actually now have a shrinking population under the age of 14. Labor force has peaked in 2010. It's all retirees from here on out. They spend less money, and they need these financial assets in order to spend. And we're taking risks with them that are just extraordinary.
It's a fascinating concept, the idea, and your work on it's been amazing, but the concept, people always say, what will be the catalyst to that going? One aspect, I think, in breakfast we're talking about, well, we're saying the catalyst is the Tinder enough, but the demographics, I mean, I was saying credit, we might need to see some sort of seize up in credit or in that dynamic, the availability of credit, but you were saying the demographics alone are enough to cause this to tip over.
Yeah, I mean, one of the things that is Chris highlighted, we've done an amazing amount of work on this. The retail sector is just being destroyed right now. Everybody's well aware of the Amazon dynamic. Right? Well, the interesting feature is Amazon can't account for what you're seeing. Amazon's sales are not growing rapidly enough to explain the overall decline in the industry. What's actually happening is that you're seeing exactly this demographic transition. If you roll this forward over the next decade, as crazy as this sounds, the statistics would suggest that aggregate retail sales in the United States should shrink in an order of about 20% in real terms. That should be scaring the hell out of everyone, right? Because that's suddenly into the credit markets. Now we're talking about commercial mortgage-backed securities, which guess what? They're getting destroyed. And you're suddenly talking about auto sales because people don't drive nearly as much as they get older. We're seeing those begin to deteriorate. We're seeing expectations around all of these areas that this is just a little blip. This is something we've seen before. It's just going to pick back up, and if we can only accomplish some political objectives, we'll accelerate our growth. It's not happening.
So you said this in one of your notes, but I guess an immediate bankruptcy of Sears will cause more job losses than the entire. Am I getting that stat right?
It's pretty close, right? So, I mean, the entire slowdown that we saw in the oil and gas space resulted in somewhere in the neighborhood of 68,000 job losses, right? Sears alone currently employs somewhere in the neighborhood of 200,000 people, right? And, we will see those go. Those are leaving.
But sometimes people talk about, they'll ask, well, what do you think will get vol going? I mean, I tend to think all of this reflexive strategy is the snake eating itself. Is sort of like a massive tinder on a fire that's potentially going to ignite. It's kind of a cliched metaphor nowadays. But, when I look at it, the slowdown in credit is really, slowdown in credit creation is really something that causes vol to explode. And it always has historically. It's hard to find a vol regime shift that has not been characterized by a slowdown in credit creation. And as a result of that, in some ways, the Fed and global central banks have, by loosening the spigots of credit, have allowed many firms to act in sort of a zombie state where they can continue on. This is perpetuating this low-vol environment. But I think, if you look at what equity is, really, equity is a option on the perpetual success, or a perpetual option on the future success of the company. So to that extent, when credit creation and companies can have easy access to credit markets, it allows for a lessening of the volatility in the equity portion of the balance sheet. So volatility is a brother of credit. They are brothers. And when we begin to see seize-ups in credit markets, typically we end up seeing a regime shift following volatility. And you can go ahead and you can map OAS spreads, delinquency rates, go take the VIX and go map C&I loan creation, delinquency rates, OAS spreads, and you'll see what I'm talking about. The relationship is quite clear. So right now we haven't really seen that immediate slowdown in credit, but I think that's the thing that can set this fire off. Now the problem at the end of the day is that we have so much self-reflexive tinder through all of the strategies we're talking, it's not just short vol, but implied short volatility strategies, like the indexation, like the beta strategies, like the smart beta strategies, like the factor-based investing strategies, which have a short vol profile, even though they're not literally shorting volatility. They are short volatility in their profile, where they're using vol as an input mechanism to drive the risk exposure. We potentially will see a seizure in the system when the regime shift occurs as a result of all of this buildup that's occurred from the moral hazard of central banks.
Yeah, and I guess we should wrap up so we leave some time for questioning, but the thing to remember about catalysts, and this is the point that I try to make with the sharks in the water, right? It's the existence of the situation, right? Maybe somebody's stupid enough to be shaving their legs as they're riding on their paddleboard and their blood in the water. Or maybe somebody just falls off. Or maybe a curious shark comes over and bumps your board and you panic as you fall into the water, setting off, an underlying dynamic. What concerns me is actually what we just saw in the past week. To me, this was a really important trigger. We heard other people mention similar dynamics. The presentation we just saw highlighted the nature of persistence of volatility regimes. The idea that if there's a shock to vol, as we saw in the past few days, that vol will be slow to recover in its pricing because there's theoretically information content in the history. What it looks like to me is actually happening is now the machines, the algorithms that sell vol, have been given permission to ignore the traditional, chief risk officer type frameworks of saying you are going to respect realized volatility. And we just saw that collapse. We saw implied volatility collapse in the face of a 5 standard deviation event within literally 36 hours. That's the equivalent of shouting out and saying, hey, get out of the water, and teenagers saying, hey, this would be a great story if I actually am out here. What an amazing thing to be paddleboarding with great white sharks.
You look at sort of things that have occurred. I mean, talking about it for breakfast, it's amazing. Everyone talks about XIV, how amazing performance of XIV. A 2% down move in the S&P and XIV loses 1/3 of its value in a single day. That is not a product that is going to survive. Even a shock that occurred in 2007, it won't survive the shocks that occurred in 2007. So you look at it, there was a mutual fund, or there was a liquid alts fund this year that was shorting convexity, it was shorting calls, and its blow up, it lost 1/3 of its assets. It was a $3.5 billion.
6% move.
Yeah, about a 6% move. So if this is causing dislocations, this liquid alts fund was not able to rebalance, it was causing liquidity dislocations in its market, which was driving many of its losses in a cycle. If this is happening with XIV, if it's happening with a $3.5 billion liquid alt fund, what is going to happen to the $60 billion worth of short vol exposure, and then the $200 billion worth of vol targeting exposure, and all the other exposures? I mean, we haven't even really touched the surface of the problems with indexation. Smart beta.
I mean, there was a note that came from Barclays actually this morning that highlighted what I thought was just an amazing thing. It's one of these things that you read this, you're like, I can't believe you actually said that. The observation was that we saw discontinuous moves in volatility markets on a 40-point decline in the S&P. And then the question was asked, well, what would happen if it had declined 44 points? And the answer was, we don't know. We actually don't know, right? And this is the dynamics of managing straddles. If you move outside of the straddle, the characteristics completely flip. That's why risk managers hate guys who are short straddles. They understand that they generate positive P&L, but they just absolutely hate it. And they will always ask, how are you going to manage this? How are you going to manage this as you get closer and closer to your barrier point? Because the relationships flip on the other side of that. You suddenly find yourself very, very short or very, very long, right? This is kind of where we are. So we should probably stop. We've got 5 minutes left to take questions.
Ladies and gentlemen, the market is one gigantic short straddle.
It's how it's set up.
And on that note, I think we'll break for questions as you suggest. Do we have any questions?
So you folks run portfolios and books that contain volatility. So what have you been doing? Have you been long losing money? Have you had no position? Clearly you're not short since you're advocating against it, right?
Yeah, so the job of Artemis is to find ways to own long volatility and not bleed to death. And we have absolutely done that. We've absolutely done that. We've returned money to our clients, given them a return, not a huge one, but we've given them a return since 2012 by owning long volatility. I want to be on the opposite side of that extremist situation when it hits. And that's been the philosophy of our Las Vegas fund and what I do.
So, I run a portion of a book that has different characteristics than most people have. And I get to express my point of view. I can go long, I can go short, I can do whatever I want. What I showed you in terms of the smart beta products, in terms of the embedded optionality, is really what I've been doing. So as cheap as vol is in the exchange-traded space, it's extraordinarily cheaper in the embedded space. The structure of the portfolios that are being built on the quantitative basis, the smart beta portfolios, particularly in the context of a change in flows, which we're seeing. The retirement of baby boomers is a real thing, and it is absolutely impacting things. It allows me to create options that are fantastically cheap. So my portfolio is currently, it behaves as if it's net short the S&P, but it has significant positive carry.
Yeah, in fairness to the intellectual credibility dynamic, I mean, I think at the end of the day, Mike is a guy who has made money, a lot of money shorting vol. At points in time,
it's much easier, right?
Yeah,
it's a much more profitable
at
strategy.
points in time where it was very, very smart to.
Yeah.
And in fairness to Artemis, I mean, I'm on one side. My mandate is to go long vol. So take that what you will. But we met because of a paper back in 2012 where I argued that the left tail was incredibly overvalued. So I think there's a strong history of being able to call the environment as we see it. And so it's not just, I guess we're talking our books because we believe in what we're saying. I would hope so. But I think it's not like a perma bear type of scenario at all. In fact, sort of
Yeah, no, I always joke that in the period immediately following 2008 and 2009, I people literally would refuse to talk to me because they thought I was just a crazy bullish guy. And all I did, you always want to watch for these features. There was a regulatory change that happened in 2006, structurally changed the characteristics of the vol selling market, skewed the long-dated space, and invited participants into the market that had historically not been there. And when they went away, the regulatory requirements didn't change. Volatility prices exploded, remained elevated, give or take through the summer of 2012. From 2012 to 2013, I don't even use central banks in explaining my market reaction function because I think it can fully be explained by the behavior of the unwind of the regulatory systems that occurred in that time period in the vol space. It's really cheap to obtain insurance to build properties on waterfront. Right? What are you going to see? A lot of properties built on waterfront. That's what risk-taking is. Right? That's just not the case now. It's the opposite. And people are underpricing it to a degree that has, in my view, greater severity than it actually had in 2007 because we're so much closer to a terminal point at which people don't have the option of working. They don't have the option of staying in the markets.
We have time for one more question.
Hey, it's Nick Cherney from Velocity Shares, and I couldn't
Raise your
resist.
hand up, so I'm sorry, it's really hard to orient where you are.
Oh, there we go. I couldn't resist the chance to take you up on your XIV here. So we have XIV, we have XIVH, which is a systematic version of XIV. We have EXIV, which we just launched, which does the same thing on B stocks. We also have systematic long vol strategies that we talk to people about. But I had a question for you and a couple things to clarify. So one, I think what you're missing with XIV is that your analogy about the consistent need to double down is certainly true if you're short VXX, right? If you're long XIV, it's floored at 0, which matters a lot in an 08, right? So XIV would have had a drawdown of 90%.
But you'd be at 0.
What's that?
You'd be at 0.
Well, you won't be at 0 unless it moves 100% in a single trading day.
Yeah,
So that's actually not true because it has a force majeure clause at 80%.
Yeah, that's right. Yeah, exactly. You'd be down 80%.
So on a single trading day. So
yeah, like in 87, or actually even February 27 of 2007, where the VIX went from 11 to 18.
no,
That's
that's incorrect because it's linked to VIX futures, which, as you know, are totally different than spot VIX. So XIV, if it had been around in 08, would have been down 90%, which is pretty painful. It would take me 6 years to get back to break even. It definitely has significant risk involved in it, but it's a different risk, and there is embedded optionality in it.
What about the one-day shock where VIX moved from 11 to 18?
I don't care what happens in VIX.
Or what about
VIX futures? All that matters is what happens in VIX futures.
So to be clear, right, you guys are actually talking about two separate metrics, right? So
yeah, that's fair.
the performance of XIV is tied to the VIX futures. There is nothing that prevents the VIX futures from rising by 80% in a single day.
No, it's never happened, but there's nothing preventing it from happening.
So that's because they didn't exist in 1987.
Yeah, but so even if you were to do some sort of like very crude analysis of a move in VIX futures for a given move in spot VIX, and even if you ignore the changes in spot VIX from 87 to today, you still don't get to that move in VIX futures. But listen, it's possible.
I don't agree.
I disagree.
I completely disagree. I've done that analysis.
I did too, and we have a different point of view on it. But the bottom line is this, that it is not the same thing as being short VXX. It's two totally different pair profiles, and that's why it's widely traded. However, my question to you is this. You guys think that basically there are times when you should be short vol, right? What are those times? Because when VIX
2012, 2011, 2012. You ended up, like there was the period coming after the spike after 2011, you ended up with tremendous left tail valuation. Everyone was in so that was a point in time.
But
I wrote a paper about it and Mike executed the trade. That was a great time.
Haven't been a good time?
I'm sorry, what?
The last 12 months haven't been a good time? They seem to have been...
Not risk adjusted, no. Not on a risk adjusted basis. It goes back to the shark example. So it's not about whether it worked or not, right? It's about whether or not you're being compensated for the risk that you're taking. That's what matters. That's what matters. And I think what we're saying is in 2012, you were very well compensated for the risk of the interest rate volatility, both on forward term structure, on skew, everything else. In this environment where long-term vol has come back to 2006 levels, you're just not being, or even in term structure with this compression, you're just not being compensated on a risk-reward basis the way that you were back in 2012. So it's a different environment, and I think that's the dynamic. One might sit back and say, when you're systematically applying something, you can't systematically do something ad nauseum. Like, I like eating a hamburger, but if I systematically eat hamburgers, they made a movie about that. It's called, Super Size Me. I get sick. If I ask a girl out on a date, and she says yes, and then we go on a date, and she doesn't want to date me anymore, and I systematically keep asking her out, it's called stalking. That's bad. So systematically applying anything is bad. There's times where it works, there's times where it doesn't work. It's risk adjusted.
Right, and investors are systematically long risk. That's how we earn return. So, listen, everybody has different trades. I thought the presentation was fantastic. I'm not arguing with you about it, but I do think you're missing some important technical points around how XIV works and why people trade it, how the other short vol products work and why they're traded. But at the end of the day, investors are systematically long risk. So your analogies are hilarious, but they kind of miss the fact that there is a systematic bias towards being long risk as investors, and being short vol is an extension of that. It has to be well applied, it has to be thought very carefully, but there's a reason that people trade XIV the way they do.
Would XIV survive 87?
I think it would have, yeah.
I disagree strongly.
So I strongly disagree, but with that point being made, are you pairing XIV and VXX?
Me personally?
Yeah.
No.
Okay. It's one of the more common strategies that's out there. Imagine the scenario where you are short XIV and you are short VXX, which is far higher Sharpe ratio, far higher adjusted return than any of the strategies you're describing. Right? The scenario emerges, whether it goes to zero, whether it encounters the down 80% force majeure, which is a very real barrier, right? It doesn't matter. If you're in that trade, you're suddenly net short naked VXX, which is positively correlated to volatility, as it spikes through the roof. And there's more than 100% of those shares short in the environment in which what you are actually presuming is that the underwriter of that is going to continue to allow creation and redemption processes. XIV has 160% of its shares short. If they decide to enact force majeure, what price can I extract from you on this?
So I didn't advocate a short VXX long XIV trade. You mean a lot of the people are also hedged in VIX options, right? So, there's a lot of other pieces that exist. My only point is one which is very simple, which is that whether it's XIV, EXIV, XIVH, any of the other kind of short vol products that are out there, all of them have a daily reset function, which dramatically changes the payoff profile in extreme scenarios. And that is a very key element of a lot of the trading strategy that goes on. You haven't talked about them being largely retail products. That's another thing I would pretty vehemently disagree with.
Oh, I didn't say they're retail products. I didn't say that at all.
Chris,
They're being traded. If you go look at Citi.
The presentation of the risks are clearly in that framework. But no, those are absolutely institutional products. This is why you're seeing introductions of 2 times, 3 times, 4 times levered products, right? People are looking to enhance that volatility, the gamma scalping activity that we're talking about. Right? It's, it is what it is. You certainly are entitled to trade, and you certainly are entitled to do your analysis of historical results. But that's one of the things that we don't know. Right? I always tell the joke that an old fish is swimming along, passes 2 young fish, shouts out to him and says, "Hey boys, how's the water?" Young fish look at him weird, swim on a little bit further. One of them turns to the other and is like, "What's water?" Right? You're inhabiting a world when you're trading these products that presumes a liquidity feature, that presumes that the environment that they're based on historically reflects the world in which they're active participants. You have no basis on which to make that statement.
But isn't that true of any product we're trading?
Absolutely.
I mean, this is just the nature of our business, right? And going back to Parendo's paradox, I get it that you can't double down.
Just repeat on mic so everyone can hear it.
Sorry about that. But going back to Parendo's paradox, I get it that you can't always double down and there's a risk of ruin somewhere in there, but I seldom know of, and I may be naive, but I seldom know of any institutional, let alone retail investor that trades only VIX or volatility as an asset class. So, I mean, I get your supersize me example with burgers. If someone wants to try it, fine. But for the 90% of us common mortals, we still eat asparagus or risotto or whatever it is. That's what it is.
One of the concepts though, at the end of the day is that, if we go back to the supersize me example,
Yeah.
Michael Pollan came out with a book that says that, I think it was Omniverse Dilemma, that says that of the modern diet, everyone ends up eating corn. Like if you chemically decompose the modern diet, most of it, 70% of it's corn.
Right.
Corn starch in some way, some derivation of corn. And I think one of the things Mike and I are really trying to say here is that if you actually chemically decompose modern institutional asset management, 70% of it is short volatility.
Yeah.
Some of it might be literally short volatility, some of it might be implied short volatility in the way that the return profile plays off, but it's all short volatility in some short volatility, short dispersion, short correlation in some fashion. And this is, I think, where people end up with this. They end up with this kind of illusion that they think they're actually having these different sources of return, but it all correlates to the same kind of asset profile, particularly when there's disruptions in market, liquidity, credit disruptions, and everything else. And I think we've just gone a very, very long time without any type of disruption. People aren't asking the hard questions or looking at these return streams, and they tend to be blinded by the fact that it's quantitative or it's machine learning that's driving return. Like it's some sort of magical solution. And what they don't see is, this might be machine learning, or this might be a quantitative strategy, or this might be risk parity, or this might be factor-based investing. But at the core of it, it's all technically short volatility, and it's going to behave one way when the shit hits the fan. And that's I think the core kind of idea that we're saying everything is in many ways converting to a straddle. The same way 70% of the modern diet is cornstarch.
Okay, unfortunately on that note, I say fortunately, depending on what view you have, we're going to have to stop there. You want a question, David? Is that what you want? All right. You owe me 3 minutes.
I guess 2 comments to the question. The first is thank you. There's it's very difficult to deal with volatility at a fundamental level, and Chris, you've consistently done that over time, and this presentation got to that. So that's great stuff. Thank you very much for contributing that. With respect to this conversation that just happened, from a sell-side seat, this is the debate that I'm on the front line of every day, and Deutsche Bank officially invites this to continue at a point to be determined in the future. I'll reach out to you.
He is a good salesman. You can tell.
So you have that right now. But I guess my question for you, and I'd like you to answer it individually from your own perspective, is how big does a move have to be before this begins to unwind? In percentage of spot terms only, not fall shifts. How much does spot need to move? And you can answer over a day or a week maybe before we have the type of super spike that you guys are hinting at.
So we've actually done a fair amount of this in part because I'm trying to understand the embedded options that are being sold in these strategies. It sounds crazy when you say it, but if you were to actually model where that straddle, where those strikes appear to be, the market appears to be something in the neighborhood of shorted 3% out of the money straddle on the downside, and about 4 to 5% because of the skew that exists in volatility, where volatility falls as prices rise to the top side, right? What that means is that Barclays is asking a very good question when they say, we don't know what would have happened if we fell another 40 points.
I don't know, and I don't claim to know, but I do look at history as a guide, because I look at 87 as an interesting parable. A lot of people think that 87 was purely caused by portfolio insurance, and I would disagree with that fact. I think I was writing a paper and I said there was fear before there was horror. And 87, you saw, interestingly enough, you saw a quick increase in inflation. The nominal rate shot up faster than inflation. This was way before October. This was earlier in the year. And so what ended up happening is the increase of nominal rates over inflation, sharp move higher nominal rates, caused the liquidity seize up, that caused credit spreads to increase and interbank lending to slow down. And then we had, so it was an ensemble effect of both credit and equity market weakness. And we had an 11% drawdown that led into the Black Monday spike. So it was actually very similar to what was experienced in August of 2015, except volatility didn't stop and the market didn't stop going down. There was an 11% drawdown. Vol moved from the teens all the way up to 30, and then went from 30 to 150 with a one-day 20% decline in markets. And then it was back to central banks to save the day. I don't know the exact numbers. I'm not that smart. But what I would say is to look at this kind of ensemble combination of liquidity seizing up and also minor drawdowns that begin linear and then rapidly progress from linear to nonlinear and across multiple different asset classes. And that's kind of what I would be interested in seeing happen. That'd be my proxy.
Okay. We have run out of time. Please do join me in thanking Chris and Mike for their perspectives.